Good evening, everybody. We're going to cut this right off at 9 o'clock because I know you all want to watch the debate. And I look at the politics of Washington. I can remember back in, was it the 90s, when they had the program Dallas with a J.R. Ewing. People couldn't wait to get home at night and watch that program to see how crappy they would all treat each other. Well, I think American politics has put that one out of business because it's just fascinating to watch how our politicians like to treat each other so crappily. That was the beginning of reality TV, that's right. So anyways, we will, same with Soupy Sales. The only thing I remember about Soupy Sales is one time he told all the kids to go to their mother's wallet and pull out $1 and put it in an envelope and address it to Soupy Sales at such and such. I think he had $10,000 come in from that, but he got fired for doing that. Okay, we're going to go through this because this is a very appropriate topic, because with the market moving the way it is, we're going to go through the PowerPoints first. What's our first priority? We're usually trying to find the best possible trades. And that's usually based upon common sense analysis that we've got built into candlesticks. And what do the candlesticks tell us? When there's been a change of investor sentiment. Next, we want to know when it's time to enter and exit those trades optimally. So whenever we see a situation like this, where it's doing a nice signal right at an obvious spot, we want to see what happens the next day to tell us that we want to be buying that. So that's as simple as candlestick analysis basically is. Now, a lot of people will say, well, how do we trade? Oops, I just remembered one that I need to illustrate. I think it was lithium. So how do we know when to get into a trade? Well, the entry strategy is very simple. There's 4 quadrants. If the market is opening higher, and how do we know if the market's opening higher? Usually on the pre-market or on the financial news stations, pre-market, they'll have a little bug or a little box down in the bottom right-hand corner that will show you what the pre-market futures are doing. Well, obviously, if the futures are up 120 on the Dow, that means the Dow's probably going to open up about 120 points. Now, if that fits into our analysis that we looked at the chart, and we'll look at that in the chart, live charts when we get down here. But if that fits into what we think the trend is doing, we've got 4 quadrants. If the market opens higher, and the stock that you're looking at is opening higher, you probably only need about 90 seconds to decide whether to get into that trade. Now, there's caveats to that, which we'll look at. If the market opens higher and the stock that you're looking at is opening lower, obviously there's not the bullish sentiment that you thought was there. However, where's a good entry point? Well, if it opens lower and it starts trading positive from where it opens, you're getting another bullish candle. And when it comes back up through the previous day's close, it's pretty much confirming the bulls are there. That's when you can be buying. If the market opens lower and your stock opens higher, the one you want to buy, well, you don't have to jump right in. You can wait to see whether they're still buying even, or if they're just kind of hesitating when the market's going lower. and you just wait, and that's where you can watch to see if the market's opening lower, and then you go to your 10-minute charts to see whether the market's starting to come back up and the stock that you're looking at is starting to get some strength. Then the fourth quadrant is the market opens lower and the stock you're looking at opens lower, and you're not going to do anything with that. So what we want to look for is just common sense. What is our best trade setups? If we can see a buy signal and a pattern, we're looking for bullish confirmation. That's about as easy analysis as we can get to. Because if we see a pattern setting up, what is the whole purpose of candlestick analysis? It's to identify the signals that tell us there's been a change of investor sentiment. And not only do we have the signals, but we have what we call the top-ranked signals and patterns. That's a combination of signals and patterns that in conjunction with each other, like a best friend signal, a doji gap up, that tells us we want to be buying. That's the reason we call that your best friend is because you've got high probabilities that not only is it going to move higher, but it's going to move higher with great enthusiasm. Now, you add the prospect or the perception, not the perception, the visual element that they've closed above the T-line. And what's our very simple trading strategy as far as the Japanese race traders have professed? You see a candlestick buy signal in the oversold area confirming you want to, probabilities are it's heading up. We've been able to add other information because of the computer technology that if we see that buy signal and a close above the T-line, remember our simple T-line rule. You see a candlestick buy signal and a close above the T-line, you're in an uptrend until you see a candlestick sell signal and a close below the T-line. So we can use other indicators like the 50-day moving average. If we see the best friend signal in this type of situation, where do you think our targets are? Up here at the moving averages that everybody else is watching. Same scenario. Right now, Tupperware. This is why I always say observe the obvious. Where is the buying? And this is because moving averages, especially the major moving averages like the 50 and the 200, that every major money manager around the world uses to make their decisions about their portfolio, we can see what's happening. There's a morning star signal right smack dab on the 50-day moving average. That's not a coincidence. All that is graphic depiction of what the investor decisions are once it hit this major support level. So here's the common sense analysis of why moving averages usually will tell you what's going on. Because if you're a major money manager and you like Tupperware and you've discussed it with your investment committee and they say, all right, go ahead and buy 4 million shares of it for the fund, where are you as a trader or a part of that, what's the grayish line? That's the 34 EMA. Where are you going to buy? You're going to probably wait for it to drift back to a support level. Because if you start buying here, what's the worst case scenario? But if it doesn't work, at least your investment owners of that fund said, well, at least you bought at the right time and it didn't work. Instead of buying somewhere in here and then having to hold on to it. So, yeah, the gray line is a 34 EMA. So new folks, the blue line is the 50-day simple moving average. The big red line, which is not on this chart right now, is the 200-day moving average. The reason those are on here is because all major money managers use those moving averages to make their decisions about their portfolio. We don't use them to make our decisions. We use them to see what everybody else's decisions are. So for Tupperware, what's the entry strategy? What is the entry strategy, Jake? Buy on positive trading. Because what is that telling you? One, they support it on the 50. Two, it's confirming kind of a morning star signal. Three, it's telling you the T-line is not acting as resistance anymore. Has all the prospects of a good reversal. Stochastics coming up. Yes, so if this opened positive tomorrow and I was buying, where would I not want to see it close? Wouldn't want to see it close back below the T-line. Because what's our T-line rule? That if it closes below the T-line, the probabilities are extremely strong that you're in a downtrend still. That's what I put in my message. The question is a stop. If I was buying on positive trading, what's my expectation? High probability, a morning star signal off the 50. Which way should it be going? Where should it not be going? If it opens positive and closes back below the T-line, close it out. It's not working. So anyways, I keep reiterating, this is not rocket science. This is just common sense using the probabilities of what the Japanese rice traders told us were buy signals. The linchpin of your method is based on candlestick reversal signals followed by a crossing of the T-line. However, I've noticed that most of the examples I see seem to be trend continuation signals. Are the trend continuation signals more reliable, more abundant? Tom, you've got two elements. One, what happens when at the beginning of the trend? And two, a simple analysis is you want to buy candlestick buy signals, when the stochastics are toward the oversold area. You want to buy candlestick patterns when the pattern breakout usually is when the stochastics are in the overbought area. The T-line is the 8 exponential moving average. So let me get to a chart that has not, still don't see a chart yet that has all, we'll get to it. But you're going to see the blue line, the 50-day simple. Red line, when it comes on here, is the 200-day. I have the 34 on here. It works reasonably well enough to have it on as what I call a secondary support and resistance. But here's the most important one, the T-line. It's the 8 exponential moving average. The description of the T-line is that it's got Fibonacci characteristics. It acts like a natural support and resistance level of human nature. So here is probably the most concise statement about candlestick analysis. If the candlestick signals are the graphic depiction of investor sentiment, and the T-line is a natural support and resistance level of human emotions, when you combine those two, you've got an extremely powerful combination. So there's a very simple rule. If you see a candlestick buy signal and a close above the T-line, you stay long until you see a candlestick sell signal and a close below the T-line. This is recorded, yes. If you see a candlestick buy signal and a close above the T-line, you're in an uptrend with a high degree of probability until you see a candlestick sell signal and a close back below the T-line. So whenever we see something like this, we're looking for high probability trade setups. This is an older chart, but there's your kind of your best friend gap up, and then you're above the T-line. The probability, I guess this was an 80% price move, but that didn't stop us from thinking that maybe it could be up another 100, 200, 300%. The nice thing about recognizing what's happening in investor sentiment. A lot of people says, oh, shoot, I don't want to buy a stock that's already up 3, 5, 10, 15, 20, 40, 80%. You do if the signals are telling you there's a lot more. So we can, in a market like we're looking at right now, candlestick analysis has a major advantage to it. It can pinpoint the signals and patterns that tell us we have a high probability of a price move in spite of a lethargic overall market. Essentially, it's numbers. There's about 9,500 trading entities in the markets. On any given day, with very simple scanning techniques, if you don't know what you're doing, you're still going to be able to find the best trades in less than 20 minutes. Once you start getting an eye for what you're looking for, you're probably going to find the best trades for whatever time frame you're looking at in 5, 7, 10 minutes. So this is what we call a bobble breakout. This is a derivative of a J-hook pattern. A J-hook pattern is a wave 1, a wave 2, and then a J-hook going into wave 3. We call this a bobble breakout because it's more defined. It showed you exactly where the wave 1 was over, there was profit taking, and it tells you exactly when you can get back in, getting ready for wave 3. And as we illustrated before, whenever you see that best friend signal, a doji gap up, the probabilities are pretty strong that you're in an uptrend. Where's your first target? More than likely they could bring it all the way back up here. Now, I always reiterate that the most important factor on a candlestick chart is the candlestick signals. A lot of people ask, well, can you use the Bollinger Bands or Fibonacci retracement numbers? You can use everything that enhances the probabilities of being in the correct trade. So if I was buying this, and I could see it had a nice big steady downtrend, where's my first target? I don't really know. But if I put the Fibonacci retracement numbers on, I can figure, all right, might be here, might be here, might be at the retracement. I don't know where it is. All I want to do is see when it hits one of those levels, am I getting a candlestick sell signal? Pattern breakouts. Ramp, nice fry pan bottom. What did it do today? It broke out. What's the implication of a fry pan bottom breakout? The investor enthusiasm has come in. Look for a very strong price move. And we saw a lot of these today on the insurance companies. I have no idea why the insurance companies were all strong today, or most of them were strong. But I don't have to know. All I need to know is they're buying. There's, again, your bobble breakout. Where's your first likely target? Well, at least probably up here to the 200. And then see if it breaks through that level. What we're looking for is the signal and then the potential target. Now, if this was a move, if we were buying on this day, with this being our target, if we can calculate that that move is a 28% move, that's exactly, oh, is that it? Medicare enrollment? Okay, no wonder there's so much advertising of that on TV. So we've got the visual analysis capabilities to say, here's my buy, and here's my potential target. Now, what will it do at that target? We'll just watch to see what happens when it gets there. Do you plot the simple, the 20 moving average, looking for a crossover of the T line, or the 20? No, we're not buying crossovers. Everything hinges, not hinges, but everything is predicated on the signal. The most, what do I want to say, consistent investment training or trading technique has been the candlestick signals because it uses the most consistent indicator in the world, human emotions. So everything that you see in a candlestick chart is just purely common sense put into a graphic depiction. If you have other indicators that you know everybody else is watching, like a crossover of one moving average to another, you don't use that as your criteria. You just use that as added confirmation that the signal is being seen by other people also. Not the signal, but the signal is confirming what everybody else is watching and why they might be buying. This is what we call a muffin pattern, which is a morning star signal, which is a big down day, a day or two of indecision, and the third day closes more than halfway up this candle, in this case above the T-line. And it was followed by a doji sandwich, a big bullish day followed by a doji, and then we have a simple doji rule. The price will usually move in the direction of how they open after a doji, which means this candle right here is usually going to be the same magnitude as this candle right here with the doji sandwiched in between. So we call this a McMuffin because that's kind of your morning star signal, doji sandwich, or your morning sandwich, a McMuffin. Oh, no, not necessarily a scoop. I'll try to find some scoops for you. So this is how simple analysis of candlesticks are. There's your doji best friend gap up. Where's your target? Probably up here. So this is why we can easily find things that are breaking out. This is your kicker signal. Opens here, closes here. Now it gaps up and opens above where it opened the previous day and goes the opposite direction. That would have told us that the NASDAQ is now going to have a very strong uptrend. And this was the chart from March. Look at your morning star signal followed by the doji sandwich or your McMuffin. Then a few days later, followed by a kicker signal, your strongest signal. On these days right here, we were saying the bottom is in. Get ready to buy. And it wasn't because we were any great market timers. It was because we had a best friend gap up, creating a morning star signal with a close above the T-line, followed by a doji sandwich. And we know what the results of a blue or of a doji sandwich is, more upside. The kicker signal is where it opens here and closes here. Look, it's a dark candle. Dark candle is where it opens and closes below where it opens. The next day, they open it at or above that open, and they go the opposite direction. They basically have kicked the investor sentiment in the opposite direction. Okay, so we're going to go here to live charts, but Pat wanted us to put this out there. Here's kind of the membership sign up for the day or for the website. We have Becky just put the link in. We've got the chat room open all day long. It's an excellent place to learn how to use candlesticks much faster because you got a lot of people in the chat room that have got a lot of experience that identify the strong charts. And if you have a question or not clear on something, all you do is put the question in there. If people in the chat room can't answer it, I'm sitting here watching most of the day and I can answer it. I put out 2 or 3 stock picks every day. Not so that you have stock picks, but you can look at the 2-minute video each night to see what the analysis is of which way we think the market is going, and then which stocks have the best prospects for moving up. Now, we don't put out stock picks just so you have stock picks. We put them out so that you can see what the visual analysis or the rationale was for that being a good trade. But the important factor is that when you're in the membership area, the number one criteria is teaching everybody how to do their own scans, so that you've always got a supply of good trades, which helps keep your emotions out of your trading, which always goes back to that if you've got a trade that doesn't look like it's working very well, you don't have to worry about whether you want to hang on to it because it might go higher. You've probably got a supply of good positions that you just take that iffy position, close it out, and move it to a better position. Mike, Jim, you have the link. It's in the members area, and it should be stock picks, under stock picks. And then late in the morning after market settles down, we put out a morning comment. We might say, we'll get to that here in a second. Let me go to live charts. Get rid of this. All right, so here's how we start the day out. When I get close to a TV, I want to see what the pre-market futures are showing. Today it was basically flat. So here's the analysis. There was our morning star signal. There was our gap up through the T-line. We were in an uptrend. Oh, I forgot to mention the caveat. The caveat is if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line, with the caveat that the further away you move from the T-line, the higher the probability it's going to come back and test it. So when they gapped this up, moved a little bit away from the T-line in the overbought condition, and the next day they did one of our 12 major signals, the bearish harami, it was time to take profits, because where would you think is likely moving to? Back to the T-line. Now, open positive the next day, we're getting ready to buy back, except they started selling it off. And what's our simple rule? The T-line rule is if you see a sell signal and a close below the T-line, the probabilities are extremely strong you're in a downtrend. In this case, you've seen the stochastics top out, heading down. So this is just taking the probabilities based upon candlestick signals and patterns that it was time to start closing out long positions and maybe adding some short positions. Now, we analyze the market very quickly, and that's using the Dow. A lot of people say, well, why use the Dow? There's only 30 stocks there. Because the Dow is usually representative of what's happening in the markets. You can analyze the NASDAQ. Same scenario on the NASDAQ. When it closed below the T-line, the probabilities were that it was heading lower. So whereas the Dow closed right back up to the, Mike, hold on to, if we have time, I'll get to a few, but right now we've got to assume that we're in a downtrend until they can close back up above the T-line. As we saw in the Dow, it closed right here on the T-line after bouncing off the 50-day moving average. And the S&P 500, somewhat the same scenario. We also, because the analysis on looking at all four of these indexes, the Dow, the Transportation Index, the NASDAQ, and the S&P 500, take an extensive period of time, like 15 seconds, to analyze what the overall trend is of the market. S&P 500, good as the Dow. Yeah, but because we can look at everything in a matter of 15 seconds, you use all of them in conjunction with each other. Mike, this charting software is called CQG. which we don't recommend. It's about $1,300 a month. It's kind of the grandfather of charting. But we use scanning softwares like Metastock, which a lot of our formulas, not a lot, our formulas, all our formulas for signals and patterns are there. So Metastock, you can pull up a chart with the Candlestick forum, what was I say, indicators on it, and it will show you all the signals as of what's happening in a trend. Also use TC2000, another good scanning software. So the identification of good price patterns is based upon simple visual analysis. DDD, 3D, there's kind of your scoop pattern. We know what should happen coming out of a scoop pattern. It has a flat handle, then the scoop, then the slingshot effect. And what's part of the slingshot effect? Came up, moved away from the T-line, took profits, and then did a bullish engulfing right off the T-line, taking us into our next pattern. Wave 1, wave 2, wave 3 of a J-hook pattern. So we have a huge advantage by identifying which signals and patterns are working with a high degree of probability. We can see how this was a J-hook type pattern, and look where it closed today. Right here at this resistance level with a big move to the upside. What's this tell us? They open this positive. We're probably in wave 1, kind of a junky wedge formation going into wave 3. These are just a few that I wrote down today. This one is setting up. Setting up because look where we had a signal. We kind of call this a bullish flutter kicker signal, meaning it opened here, closed here. It gapped up today and did an indecisive day. If it opens positive tomorrow, what's it telling us? We're probably going to have a positive candle. And what is our strongest signal? It's a kicker signal where they open it here, close here, they gap it up and go the other way. That tells you there's been a dramatic change of investor sentiment. If you really want to learn candlestick analysis fast, it's just a simple process of saying, all right, here's the bottom. What started this uptrend? Well, there's a kicker signal. Here's the top. Here's the downtrend. What started the downtrend? Remember where we said if you had a morning star followed by a doji sandwich, a morning sandwich, it was called a McMuffin. We call this a Dagwood. There's an evening star followed by a doji sandwich, or your evening sandwich, or your Dagwood sandwich. The evening star signal is one of your 12 major reversal signals. Tells you there's likely to be more downside. Your doji sandwich tells you there's likely to be more downside. So when you combine the two, the probabilities of more downside is extremely strong. Is a flutter kicker stronger than a kicker? No. But what it does do for you is maybe you didn't get into this today. And it might be because there was kind of a kicker signal. You saw a kicker signal off the 200. You might be racing around trying to find money to get into this position right away. Whereas here, you know, well, I'm going to sell my XYZ position if it's weak tomorrow and buy this one on positive trading because I can get ready for that bullish flutter kicker. Call it a bullish flutter kicker because if it opened here and closed here, another green candle, if you took out the little flutter, you basically have a kicker signal. What causes a scoop pattern? Human nature. What causes a fry pan bottom pattern? The reason we're looking at patterns is because human nature works the same way time after time. We did this one. This would be what we call a bobble breakout. What can we expect here with a high degree of probability? That this next trend will be the same magnitude as this trend right here. There's kind of our little morning star type signal confirming. in the oversold area off the 50. Notice what happens. When they come up through a, what the heck is that? Come up through a resistance level, what do they usually do? They'll pull back to see if that resistance level is going to act as support. We can see immediately it was acting as support, a doji bullish confirmation. So when everybody else starts seeing that it's acting as support, what do? They gain confidence and start buying. The advantage we have is we can see right here that it was acting as support. We're buying in here and profiting from everybody else. What was the stock before? I don't know. Oh, Axel. Or was it VIR? No, VIR was way up. Oh, did I skip a couple? There's another J-hook pattern. This is what we call the classic pattern. Look at your big fry pan bottom. And they broke out through the resistance level. There's your bearish engulfing signal. They pulled back right here to the T-line and the 200. When they went positive, what did that tell everybody? Told them when they came up through the resistance level, they came and acted to see if it's going to act as support. It did. They're buying with great confidence. What is our expectation? A J-hook pattern. Wave 1, wave 3 going to be the same. Why do we call this the classic pattern? Because here's your fry pan bottom. Here's your strong price move. Here's your profit taking. What's a prerequisite for a J-hook pattern? A strong price move. So it works quite a bit in combination where you get strong price move, the pullback. Even if you missed this move, you pretty much could calculate what this move will be based upon that move right there. Candlesticks reveal all. They are looking at this from the short for a few days back, never confirmed. Now a potential buy. Okay, let's see. When would you buy? I'd be buying this one tomorrow. Now, I probably wouldn't buy the stock, but if this was kind of my target, I could be buying calls or I could be buying spreads, knowing what my potential price move was. Again, we look at this one as a best friend signal. You can see the doji gap up, and where's our next likely target, at least up here. So if we know the patterns, there's only about 6, 8 patterns. Whoops, that's not what we want. What do we got going on here? There's your classic pattern. Fry pan bottom, J-hook pattern. You could be buying this one with the expectation wave 1, wave 3 could take you up here toward the $7 area. Now the advantage of knowing what the patterns are showing us is expectations of what usually happens. And with that, we can see when it's working, and we can see if we bought this one here thinking it was that higher and it closed back below the T-line, we're out of the trade. This is that proverbial cut your losses short and let your profits run that every money manager tells you to do, but they never tell you how to do it. If we know what to expect based upon a pattern, we know what not to expect and close out that position right away. You wait for the close? Yes. The most important 2 pieces of information that create a candlestick signal is where does it open and where does it close. Everything in between is noise. Now you could, if it came back through this level during the day, yeah, that's going in the wrong direction. You can close it out. How is a PNW different than a cup and handle? Because usually a cup and handle, well, it's pretty close to a cup and handle. Usually a cup and handle comes up and pulls back. So we call it a classic pattern. Which one is the McMuffin, Mike? Let's see. Let me. There's a J-hook pattern. Now, how come we can see a J-hook pattern more clearly than everybody else? Because nobody has the T-line on their chart. So when it pulls back, notice where it pulled back to. Back to a level that nobody has on their chart. We can see that it's supporting on that natural support and resistance level, creating the J-hook pattern. Is this, what did you call it? A McMuffin? No. No, McMuffin is that Morningstar signal followed by a OG sandwich. So when we see things like this, where do we want to buy? We want to buy the signal when we're in the oversold area. Where does a pattern breakout usually occur? When you're up here in the overbought area. But what do we expect coming out of a fry pan bottom breakout? A lot more upside. Using the patterns, do I need to follow the tendency? Tendency, I don't know what that means. Do I need to follow? Isn't this too high to buy? No, that's why you want to know the patterns. Your stochastics, not up in the overbought area, it's curling back up. You've broken out. And what do we expect out of a fry pan bottom breakout? A strong price move. So, no, that's why you're learning the signals and patterns to know which ones you can go after. So if I see something like this, kind of a fry pan bottom, we're right here in the breakout area, I'm not afraid to be buying this one, even though we're getting up toward the overbought area. What time frame do you use for stochastics when you say it's not overbought? I use stochastics at 12.33. That's nothing set in stone. Some time back, 30 years ago, I just tweaked the stochastic to say, all right, if this is the peak, what's making it head up? If there's we're at a bottom, where are the stochastics in the oversold area? Alex, I'm usually 100% invested. That's because I will always find more trades than I'll ever be able to handle. And because I have more trades than I'll ever be able to handle, anytime I'm closing out a position, I've got another position that looks good to take its place. Now, I might not be, and I usually keep my positions to 10 positions, they're all equal dollar amount, so I keep my emotions out of my trading. That each of my portfolio, it's not a favorite one, it's not one that I really think is going to do a lot better than everything else. When I look at it to see what it's doing and it's not doing well, I can say, all right, let's close this unit and go buy another unit of the portfolio. So if I had $100,000 in cash and I was going to buy $10,000 positions, maybe tomorrow I would buy one long and one short. Let's see. Or maybe if I think the market's going up, maybe I'd buy 2 long positions. And then if things still move in that direction, maybe add another 1 or 2. I wouldn't put them all on at the same time. But eventually I'd be to the point where I'd got 10 positions on, some of them long, some of them short, because I know every single day when I look at the market, I'm thinking, all right, the market's turning over and heading lower. I'm going to close out this long position and add another short position. So it's not like on one day I'm selling out 7 long positions and going 7 short. It's usually kind of a rotating or a kind of a natural evolution where the longs start selling off and you start adding short positions. So short positions are just as easy to identify. The 12 major signals are basically 6 long, signals, 6 sell signals. So there's our shooting star. There's our close below the T line. You can start going short. There's our bearish belt hold left-right combo. You can start going short. Why? Because I got a sell signal and a close below the T line. If I'm long and been long, holding, how long do I hold this position? You can see we had our fry pan bottom, J-hook pattern. What's our simple rule? How long do you hold the stock? Until you see a candlestick sell signal and a close below the T line. That tells me there's been a change of investor sentiment. If I was long this one, there was my dark cloud, close below the T line. TAL, there was your bearish kicker signal. Telling you, not only did you have a bearish kicker signal, which is strong, but you also had a bearish kicker signal that said you were closing not only below the T line, but the 50. You could be shorting this. Why? Because the kicker signals are the strongest individual candlestick signals. Because it tells you there's been a drastic change of investor sentiment. Bearish engulfing signal, bearish engulfing signal. Now, what was our alert to start taking profits up here in the overbought area? The Japanese rice traders make it very simple. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So if you're in an uptrend, and now they're gapping it up in the overbought area, the first thing you start doing is looking for a sell signal. How would you assess risk for shorting stock versus buying puts? That's up to each individual, Marshall. If I was trading out of my options account, I'm going to buy puts. If I'm trading out of my stock account, I'm going to short the stock. So it's up to each individual. There's a bearish flutter kicker also, yes. This is uptrending. Is it a short? Which one? Is this one? Yes, that's probably a short. Because you got a bearish engulfing, gap down, close below the T line. Very simple rule. And this is not difficult to remember. If you see a sell signal or close below the T line, the probabilities are extremely strong. You're in a downtrend. Bearish left-right combo, close below the T line. Netflix. Dark cloud, bearish left-right combo. The probabilities were that things were not good in River City. So again, I keep illustrating or reiterating, this is not rocket science. The signals are identifiable, and then when you combine them with the direction of your stochastics and where you close, the probabilities are extremely strong that you're going to be moving in one direction or the other. Now, I say probabilities, not guarantee. Just the probabilities are so strong, though, you don't want to fight or argue with the signals. Close below the T line, you're heading down. And what is that one? Oh, whose handwriting is this? This, I see. Bearish left-right combo. This is so strong a signal that even though it didn't close below the T line, you close it out because the probabilities are extremely strong that it's going to trade lower the next day. So you close it out so you're not caught in something like this. A dark cloud is one of your 12 major signals. A dark cloud is where they open above any of the previous day's trading. Now, this is also that where do you get ready to sell? you're in the overbought area and they're gapping it up, you get ready for a sell signal. But a dark cloud is they open it above any of the previous day's trading, and they close more than halfway down this candle. Now, if they had closed it below the open of this candle, that now becomes a bearish engulfing signal. But the halfway point is an important factor in candlestick analysis, that if the bulls are in control and they can do a dark cloud that closes more than halfway down the last bullish candle, it means the bears are starting to take control. Caterpillar, there's nothing here that's telling you there's any selling. However, you did have a gap up in the overbought area. That's your warning. You did have a bearish left-right combo that didn't confirm. So this is where in the morning comments, you can see you have wave 1, wave 2, wave 3. Wave 3 is about the same magnitude as wave 1. You're probably getting close to where they might be taking profits. So what's the safest thing to do? You put a safety stop just below the T-line, because logic says if it comes back down through there, that's where the profit taking. This works for all time frames. You could be looking at a 1-minute chart, a 10-minute chart, a daily, weekly, monthly, hourly. Candlestick charts are fractal, meaning they are exactly the same on all time frames, which means if I'm day trading, if I'm day trading and I think I'm in an uptrend and I think this might be going higher, it's up a little bit after hours, I usually trade off the 10-minute chart. So you can see on my 10-minute chart that I might be buying down here, taking profits here, buying back here, closing it out here, or going short here. And where do I cover? When I see a buy signal and a close above the T-line. If I want to get a little bit quicker, I just flip down to my 5-minute chart and see what the 5-minute chart is telling me. How much dollar percentage below the T-line would you set your safety stop? If you're in an uptrend and it's been hugging the T-line, I'm putting it just below the T-line, maybe a few cents, with the logic that if it comes down through there, it's going in the wrong direction. So it's not any percentage. It's just where should it not be trading. It shouldn't be trading back below the T-line. All right, so guess what Pat was looking for? I tell people I've been trading for, ever since I graduated from college. I became a stockbroker in 1976. So I've used every method of trading you can think of. And through the years, I've discovered that the most common sense trading application is the candlestick signals, and I could take everything off this chart except for the T-line and stochastics. The important factor is, what is my signal? Where is it occurring? I used to, coming from being the worst investor in the world, when candlesticks came along, the thing that kept slapping me in the side of the head was, yeah, this makes sense. And the more I looked at it, the more sense it made. 44 years, I think so. Is it 44 years? I don't know. It can't be 44 years. That's about right. So, 1976. Okay, I'm going to cut it off right here. You usually take requests, but we want to watch the debates to see what's going to happen to the future of our nation. This one, I wouldn't be in it. If you were long, the safety stop would have said right here, close it out. Now it's not a chart worth looking at. I'd be someplace else. When you can look at a chart and you can't tell what it's doing, there's too many charts out there that are very easy to identify. So one just would be Tupperware. I would buy this on positive trading just because the probabilities are saying we're heading higher. All right, everybody, have a good evening. Oh, again, if you want to sign up, this is what I was saying. If you want to sign up for 1 month, you're going to get a lot of information just in that month with the chat rooms, the picks. We do special sessions we do a members night on Monday night, looking at all our positions. And then sometime during the week, we usually do another session like entry and exit strategies, stop losses, scanning techniques, things that are just common sense applicable to candlestick analysis to improve your probabilities of being in the right trade at the right time. So with that, let's go sit in front of our TVs and cheer for whoever we're going to cheer for. We'll see everybody in the chat rooms. No, the Tuesday and Wednesday night sessions, Winnie, are usually maybe once a week.